Sunday, March 21st. This is Talking About Finance, and my name is Dave Coker. 7 slides for 7 days. Yeah, let's take a look. This is very fascinating. It came out of, I got it from Deutsch. It's also got BEA and Haver Analytics subtitled as credit. Now, it's a very interesting presentation about savings, and specifically excess savings, which is defined as the level above the normal background rate of savings. And two things leap out at this chart. First of all, you can see on the left-hand side, it's been negative for a while. This has been a problem for about the past 20 years. Americans just don't save money. But then something wonderful came out of the pandemic, in that people didn't have any way to spend the money, so they started to save. And excess savings is at a record. We've never seen it this high. Now, this is very fascinating, guys, because the economy, without a doubt, starting to reopen. People are getting vaccinated. Lockdown is starting to ease. And there have been some really, really outrageous predictions for GDP. Well, the people have the money. Let's just see if they put it all to work. It'll be really interesting to see what happens over the next 6 to 9 months, perhaps 1 year as well. There's a lot of liquidity sitting there, and people want to get out and do things. Next slide. We've got a really interesting presentation here from Goldman about short interest, and it's at a record low. Now, guys, remember, what we're looking at here is we're looking at the number of shorts in the market as a function of total market capitalization. And it turns out, guys, we're at such a huge low, such an enormous low, reminiscent of what we saw in 2000s, late 1990s, early 2000s. But the point is this: everybody is short, it seems. So what happens if the market flips? There are, and we'll look at a little bit later, I'll show you some interesting indicators about the market that indicates it's overvalued. Well, if short interest is at a record low, who's going to be buying stocks if they collapse? That's very disturbing, guys, because this is, when short interest gets this low, this is an indicator that if there's a downside market movement, it's going to be extreme. Everyone will be running for the exits at the same time. Everyone will be selling. Normally, correlations that might be low or even negative are all going to go to perfect positive, and we saw that with the dot-com collapse. We saw perfect positive correlations, or very strongly positive correlations, across the entire market. So this is interesting to take a look at the S&P 500 and the fact that people just are not short. Really interesting. So what are you going to do with the money? Well, buy stocks. Without a doubt, people could be buying stocks. And here's an interesting one. And this came from Yardeni. And he was chief economist when I was at Deutsch, and he's gone off and done his own thing now. And he has some really cool information, very prescient. Here's the NASDAQ, and we're looking at it for 2 periods, 1998 to 2000, and then we're looking at it from 2020 to 2022, perhaps. Guys, history doesn't repeat, but it rhymes. It's the same thing with the markets. We tend to see the same things happen time and time again. And we're being set up here. Many feel that once the economy gets into full reopening, we're going to be seeing a huge market boom. And that market boom, or economic boom, and that economic boom will lead to a market boom. And yep, kind of think that some people think tech might be the place to put the money. But could it be a bubble? This is an interesting one, guys. This is an overview of how bubbles emerge. And keep in mind, guys, it's very difficult when you're in the moment now to detect a bubble and to prove objectively. We do have models, but they tend to look back to prove objectively that the current moment is a bubble. So there's 4 phases. Let's start from the top. Smart money, institutional money, public. And this talks about the entities that are participating. So in the beginning, smart money is moving in. People notice things. They start to acquire assets. It doesn't matter what the asset is. Then institutional investors start to get involved. This drives media attention. And finally, the public moves in through 2 distinct phases. We start to hear all sorts of talk about a new paradigm. This time it's different. The emotions that dominate here, they shift from enthusiasm to delusion, outright delusion and greed. And then we tend to see a blow off, we see a sharp drop, and this is the time you want to buy, guys. Maybe you got in early, at phase one, smart money, phase two, institutional. When you start to see these huge run-ups, then you sell. And if you like the assets, you can buy back in later on. And this chart, this progression of phases, I've seen it play out many, many times in many different assets. Some things never change. Well, Mr. Buffett might think it's a bubble. And this is the Buffett Indicator. I've annotated it for you guys. We've got global market cap divided by global GDP. It's what Warren himself has mentioned several times in those wonderful newsletters, or pardon me, letters to shareholders. And if you don't read them, I would recommend you read them. They're on his on Berkshire's website. Go check them out. But in any case, guys, once again, you can see we've got extreme high, and we see when it happened before. So it's entirely a chance that it is a bubble, but still, guys, people are getting excited. And here I got an interesting chart from, I think this was from Goldman's, yeah, it is Goldman, I'm sorry, from Goldman as well. And we can see cash flows into global equity funds. A huge, huge, huge amount of money is flowing in, guys. This is keeping the stock market afloat. Well, is the money going to run out? Eventually, people are going to run out of money to speculate. Or are they? We know the stimmies are coming. Yeah, they're handing out stimulus checks in the States. I think they started about a week ago. On the 17th, actually, it started. It's not quite a week ago. And the stimulus checks are starting to hit accounts. I saw a survey. They said 40% of people who responded to the survey, it wasn't super huge. It was about 3,000 people, 2,500 people. 40% of them said they were going to put money into Bitcoin, and roughly the same said they're going to put money into stocks. And other people are going to use it to pay down bills or debt. In other words, for the intention, for the purpose it was intended. But we're starting to see now, and we talked about the Treasury cash balance last week, we're starting to see the drawdown, and that was a huge drawdown. That was a record drop. We've never quite seen a drop that high in the Treasury cash account, the Treasury general account, in terms of its balance. It's absolutely amazing, guys. And we're not quite sure what they did with the money. We know some of it went to stimulus checks. We're also aware that the Fed is engaging in some asset buying to stabilize markets. Yellen has been very vocal about saying we have to do more, we have to do more. And here we go. How is this money going to distort the markets? It's anyone's guess. Although I expect we'll continue to see asset prices rise. They'll get to incredibly overvalued levels before we finally see some semblance of reality creeping back in. And that'll manifest as a sharp market correction. And that's a good thing, guys. I've got liquidity. I'm nibbling, but I only buy dividend-paying stocks, as you know. But there are some other shares I'd like. So I'm waiting. We'll see a drop, then I'll move in. All right, guys, thanks for your time today. Have a wonderful week. Take care.